What is going on, Aces? In this next video of the Ace Crypto Beginner's Guide, I will be covering Relative Strength Index or RSIs. Now, in this particular video, I will be covering two types, the Classic Relative Strength Index and the Stochastic Relative Strength Index. Now, they are both similar in a multitude of ways, but they each have their own nuances that you can implement into your own personal trading strategy to set you up for success. Now, one of my preferred methods of trading is momentum trading. And these are momentum trading indicators. What that means is that it will help you assess the strength of the moves in an uptrend or a downtrend. This will let you know how strong the bullish and the bearish moves are. All right, let's dive in. So as always, we're looking at Big Daddy Bitcoin. This time we're looking at it on the weekly time frame. And as usual, when we start off, you have a clean chart. There's nothing on here, right? Let's get the RSIs displayed on your chart. So the first way that we do that is you want to click the indicators tab. This is at the top of trading view right here. When you click the indicators tab, it's going to give you an option to search up different metrics and strategies. So all you got to do is type in RSI. This will give you different types of RSI indicators and strategies. Ignore all of these for right now. What we want to mess around with is the classic RSI, which is the relative strength index right here. And we also want the stochastic RSI right here. Okay, so when you click those indicators, it will be displayed on your chart like so. And you can mess around with these. You can move them around. You can flip them. You can move one to the top. You can move it back to the bottom. You could do whatever you like. In this particular case, I'm going to keep the classic RSI at the top and the stochastic RSI at the bottom. But again, this is all depending on your preferences, what you like your chart to look like when you are using these indicators. Let's break down what these RSIs are and how to read them, okay? So the first thing that you'll notice about these indicators is that they act as oscillators, meaning that they bounce back and forth between two parameters, okay? So what I mean is like when it moves down to the bottom of the panel and then up to the top and then back to the bottom, up to the top. Like it just oscillates back and forth, up and down, up and down, up and down. It never gets overextended past certain parameters because that's what these are programmed for. They're programmed to oscillate, all right? So starting off with the classic RSI. So the RSI is the purple line, okay? The purple line is the RSI. The yellow line is the smooth moving average, okay? That's this right here, the SMA. So that is what the yellow line is. They both serve their own purpose, but we'll start with the RSI. So the RSI length is 14. What that means is that what is being displayed on the RSI indicator is the information is being derived from the last 14 pieces of data, depending on which time frame you are looking at. So we're on the weekly time frame right here. It's gathering information from the last 14 weekly candles, okay? And then it's, taking all that information, putting it into its formula, and then it's giving you the output on the RSI, which is what is being displayed to you. And that corresponds to what time frame you're looking at. So if you're on the daily time frame, it's going to give you the last 14 days. If you're on the hourly candle, it's the 1 hour time frame, it's going to give you the last 14 hours. The smoothing moving average, the length is also 14, so it's taking the information in the same way that the RSI line is doing, but it's being displayed differently. It's being displayed smoother. You see how it's a lot smoother than the RSI itself. So basically, this acts as like almost like a reference point, or even like a double indication to let you know what's going on. Like, if the yellow and the purple line are both at the top of the panel, then that's telling you something. If it's both at the bottom at the same time, then that's also telling you something. You're going to understand what that means in a second. So when you're looking at the RSI panel right here on the right-hand side, you're going to see these numbers here. The important numbers to keep in mind are 30 and 70, okay? So by default, the RSI indicator has the bottom like dotted line at 30 and the upper dotted line at 70. When the RSI crosses below 30, that means that it is considered oversold, meaning that the price that is being displayed on the chart. So like, for example, like in this case, when it was oversold down here, when the RSI was oversold down here, Bitcoin was trading at about $17,000, this is letting you know that that is a discounted price. Like that is much oversold than what the market price should be. Okay. And then the same thing when it gets overbought. When the RSI gets above 70, this is considered overbought territory, meaning that the price is more expensive than what it should be. You can use this to your advantage because when the RSI is oversold, then that means that you should be looking for longs. You should be looking for buying opportunities. When it's overbought, that means that you should be looking for shorting opportunities, or at least consider selling your position. So that's oversold and overbought. When you're using the RSI, you want to use it as like momentum. How strong is the buying and selling pressure during a particular move? And by observing this momentum, when things start to get really overbought or oversold, you can start to think to yourself, okay, you know, when, like in this instance, when it was extremely overbought right here, you should start to think to yourself, oh, maybe the bulls should be running out of steam here very soon. You know, maybe, you know, price could be reversing here. So you can also use it as a reversal indicator. You can start eyeing bounces or rejections, or, you know, heading into support or resistance. Like when you combine this indicator with other, with other confluences on your chart, this can be very, very powerful. Okay. That's one way to use the RSI. We're going to get into other strategies later on, but that's the basics for the classic RSI. Now, let's move on to the stochastic RSI. So the stochastic RSI looks similar in a way. It's an oscillator and it's got two lines and it goes up and down, back and forth, right? And sometimes the lines cross over and etc. But they're used, the way that it gathers its information is in a different way. So the stochastic RSI is the RSI, but it's more sensitive. So meaning that you're going to get more overbought and oversold signals in a shorter amount of time than you will with the classic RSI. So the classic RSI is slower to give you those overbought and oversold signals. The stochastic RSI it'll give you more signals in a shorter amount of time. So it's more sensitive. Now, that could be valuable when you're like a scalper, or if you're a frequent, active trader, you can, identify points where it's overbought or oversold on the stochastic RSI. However, you have to understand that because it's more sensitive, it's more inclined to give you more false signals than the classic RSI, right? The classic RSI will give you less false signals. However, when you're using the stochastic RSI, it will, when you're using the stochastic RSI with other confluences, it can be, again, very powerful. It's just like another tool on your tool belt. You don't want to use either of these by themselves just to, decide when to enter and exit trades. That's not how you want to do it. You want to combine all these indicators that I'm showing you, combine them all together. When you start to get these signals and things start to line up and you get like 3 or 4 confluences, then maybe that's a sign to exit or enter a trade. Okay. The stochastic RSI lower band is at 20 and the upper band is at 80. So for it to get overbought, it needs to get above 80. For it to get oversold, it needs to come below 20. Okay. And when you look at the settings here, at the inputs, the default inputs on the stochastic RSI. So the RSI length is the same as the other ones, 14. And the stochastic length is 14 as well. So this is gathering information from the most recent 14 candles, depending on which time frame you're looking at. Okay, same way as the classic RSI. But the other thing, you have these K and these D lines. Okay, so the K and the D lines are the orange, like the orange line. So this is based on like a 3-day simple moving average. So it's the 3-day simple moving average, but when you're getting the crossover, this will let you know like when the shift in momentum is occurring. So for example, when the blue line, let's zoom in here. Let's get a oops, wrong one. Let's zoom in on the stochastic here. So when the blue line starts to get oversold, right? And when the blue line and when the orange line is catching up to the blue line and the blue line looks like it's getting ready to cross, that can indicate to you that, hey, we're starting to get some bullish momentum. We're starting to get some bullish momentum here. So the blue line moves faster than the orange line, right? And the same thing when you start to get a crossover to the downside. Like in this instance up here, when the blue line started to cross below the orange line, this is letting you know that the bears are starting to gain momentum. So you're starting to see more momentum to the downside. Sometimes these can get vertical, like these can get very violent very, very quickly. Here's an example. So, well, you don't really see it too much on the weekly. Let's look at something like the minute time frame because these are good to scalp sometimes too. So where things can get really violent. Okay, like this is a decent example over here. So in this instance, when price action started to run up very quickly, very, very quickly, you can see that the blue line started to get very overextended from the purple line. Like when the blue line was up here, the orange line was all the way down here. So it started to get very, very overextended. When that happens, that means that you got it. Like the orange line has to catch up. Like when it gets aggressive like that to the upside, that means that it could take a while for a reversal to come down because they're starting to get spread apart during this period. Okay, so when they're spread apart, that means that the momentum can last. Like the momentum is very strong. Like that could last a lot longer than what you think. And then especially like also to the downside when the RSI is like plunging to the downside, that means it could be a while before you can expect a reversal. You have to allow the orange and the blue lines to catch up, right? So that's the stochastic RSI in a nutshell. So the best ways to use these again are overbought and oversold territories, okay? And also when you start to get crossovers, especially on the stochastic RSI. When the RSI crosses over, this can indicate to you when there is like when they're passing the torch, so to speak. Like when the blue is crossing below the orange, then that means that the bulls are passing the torch to the bears. And when it's crossing over to the upside from oversold territory, that means that the bears are passing the torch over to the bulls. All right? I hope that makes sense. Now I want to just show you like what this looks like on the chart, but again, you don't want to use these indicators like alone. Like you don't want to just base your entries and exits just based off these indicators alone. But let me show you an example of how to read these things. So let's look very, very recently, okay? So you had the RSI right here at 78.8. That's right here. At about 79, let's say, right here. You also had the stochastic RSI overbought. You can see right down here. Now, where was price? During that time, price was near its all-time high at like 108,000. And this was telling you that it was overbought. So this could be due for a reverse in price action. And what did you see? You started to see momentum from the bulls start to die off, right? And then you started to get, price action started to struggle and it started to enter a downtrend because it was very overbought. And then the bulls were passing the torch to the bears. And then the RSI is starting to trend down. The stochastic RSI is starting to get oversold and it looks like it's starting to cross over, especially after this dump right here. So we could start to see a relief bounce for the bulls. So the bulls could start to take over for a little bit. However, look at the RSI, the classic RSI. Look at how much more room it has to the downside. Now, again, this is all relative because you have to remember what type of market that we are in. And in bull markets, the RSI doesn't always fall into oversold territory. All right? I want you to understand that. I hope that makes sense. In bull markets, the RSI doesn't always fall into the oversold territory. Okay? The last time that the RSI was in oversold territory was all the way back in June of 2022, and that was the bear market. But look at where, like, we could even mark this as a bit of line of support. Okay, like right here. You see how the RSI came down to these levels around here and didn't fall below it? This was in a massive uptrend. This was in the middle of the bull market. So during every pullback, like this was a pullback over here from about 30,000 down to 24,000. This was a pullback. And then it got, it found support here on the RSI. And then it got a bounce. And then it got, another pullback over here. You see how the RSI found support right there? Got another pullback. Look at where we're at right now. We're getting a massive pullback. We're in a bull run. This is a clear bull run. And the RSI is coming close to that support again. So I would watch that. I would watch the RSI coming to that support. That would be a nice area to look for longs. The stochastic RSI is also oversold and is starting to curve to the upside. However, if the RSI loses this support line, that means that it can come down a lot further. Like it could come down, do something like this and come back down into oversold territory. That's a possibility as well. But again, in bull markets, it doesn't always have to fall down to oversold territory. And you could see this even in the previous cycle. Even in the previous cycle, when you're looking at the RSI, you can see that you got this pump, right? You got this move up here, and then you got a pullback. It never came down to oversold territory. It came down to it came down to around 40, and then it came here to around like 35 or so, but it never fell below 30. It never entered oversold territory. And then you got another run up. You got some slight pullbacks in between. You got a little pullback here, and it came back down. You got this massive pullback. This was crazy. Look at this. You got almost a 50% drop in Bitcoin right here. You got about a 55% drop in Bitcoin, but meanwhile, the RSI still never hit oversold territory. And this is on the weekly time frame. Remember this. Still never hit oversold territory. Got a bounce, came back up, and then you entered the bear market. And then you never saw the RSI hit oversold again until June of 2022 at the bottom of the bear market. So, for example, if you're a long-term investor and you're looking for the best times to buy and to sell, all you got to do is just buy when the RSI is oversold and sell when it's overbought. And that could be a very, very lucrative strategy long-term. Now, again, that's not the only way. That's not the only strategy. You can, miss out on a lot of potential gains. But if you're a conservative, less risky trader, then that's one way to do it. Okay? All right, beautiful. I hope you understand that. The next way to use RSIs is with something called divergences. Okay, divergences. So a divergence is when you have the price doing one thing, right? So you have the price doing one thing, like in this example. So in this example right here, you have the price doing one thing. It's setting higher highs, right? So you have a trend line. You have a trend line forming higher highs on the price. But what is the RSI doing? The RSI is forming lower highs. You see that? Higher high on price, lower high on RSI. This is a divergence, okay? And there's different types of divergences. So a divergence is when the price action is going in a different direction than the RSI. Okay? That is a divergence. And we have different types of divergences that I want you all to understand. You have the bullish and the bearish divergence. So you can write these down in your notes. You can, take a picture of this. I'm sure I've shared this in the Discord and in the toolkit channel. But get familiar with these, especially the strong ones. It helps to get familiar with the weaker ones, like the medium and the weak, divergences. But I really want you to understand the strong and the hidden divergences. This will help you a lot. Okay, so let's break this down one by one. So class A. So class A divergences are the strongest divergences, okay? So for a bullish divergence, this is when price is going down, but the RSI is going up. For a bearish divergence, there's a typo on this. You see how that says, it says bullish twice, but forgive that typo. red means bearish, green means bullish for the understanding of this teaching. That's a typo. They got to fix that. So a bearish divergence is when the price is getting higher, but the RSI is going lower. Okay? That's a strong divergence. A medium divergence is when the price is moving sideways, but the RSI is moving in a direction. So if the lows on a price are moving sideways, but the oscillator is going up, that's a medium. That's a class B bullish divergence. But if the price is moving sideways and the RSI is trending downwards, then that's a medium or class B bearish divergence. Now the weak divergences. If price is going down, but the oscillator is sideways, that's a weak bullish divergence. If price is getting higher and the RSI is moving sideways, that's a weak or class C bearish divergence. Okay. Now again, you want to remember that because if you see these divergences, understand that some are stronger than the others. So you might be able to catch something like that'll give you a hint. Like a weak bullish divergence, a class C bullish divergence, maybe giving you a hint that things are starting to reverse, but it's not as strong as your other divergences. So you need stronger indications from your other indicators, right? Whether that be, are you approaching a strong level of support and resistance? Are you crossing a big moving average? Are you, is there a lot of volume? Like what is going on? Like what is happening that is giving this, potential, class C bullish divergence? These divergences all tell a story. They all tell a story, okay? They all tell a story. So the hidden bullish divergence, okay, so a hidden bullish divergence is when you're getting higher lows in price, but lower lows in RSI. Because again, every divergence tells you a story. So if price is going up, right, then that means people are speculating on the asset. That means that people are buying up the price, but the oscillator is still going down. That means that the bears are running out of momentum. The bears are running out of momentum because they're trying to push price down. Like the RSI is still going down. However, the price is going up. So that means that the buyers are starting to overwhelm the sellers. The bears are losing momentum towards the bulls. Make sense? Same thing with a hidden bearish divergence. When the price is getting lower, but the RSI is getting higher, then that means that the bulls are starting to get exhausted. The bulls are pushing hard. They're trying to buy up the price. They're trying to keep on momentum, yet the price is still being sold off. So that means that eventually the bulls are going to get exhausted. Price is probably going to start heading towards the downside more aggressively. Okay? So all the divergences tell a story, right? That's basically what it means. So let's get back to the charts. And let's see if we can find some divergence. So in this case, in the most recent case, this was a massive bearish divergence. We had a higher high in price, lower highs in RSI. You see that? That is a massive bearish divergence. So what story is this telling you? This is telling you, oh, the bulls have been pushing up the price. Price is getting higher, right? But the momentum has started to get overbought, right? We got very, very overbought here. We came down, tried to reset the momentum on the RSI, and then price started to pump again, and it pumped, a lot. It set a higher high. However, the bulls weren't as strong this time. You see that? That's why the RSI is a momentum indicator. It lets you know how strong the moves are. So the move wasn't as strong this time to the upside. That's why the RSI was lower, but the price was higher. So what is this telling you? This is telling you that the bulls are going to get exhausted very soon. They're going to get exhausted very soon. And what happened? We got a dump. We could have read this a mile away. And if we would have shorted up here, that would have been, we knew we were going to get struggling price action. We knew it because of this bearish divergence on a weekly time frame. And the higher time frame that it is, the more strong the move is going to be, the more reliable the indicator is going to be. Like if you get a bearish divergence like this on like a minute time frame, it's not going to have the same effect as it would on a weekly time frame. And the higher the time frames are, the longer that these divergences can have an effect on the price, on the performance of the asset. Okay, I hope that makes sense. And I just want to be clear, when you get these divergences like this, the price doesn't always just like, dump like that. It doesn't just always dump like that. It can, it can do one of two things. It can either dump or it can just chop around sideways. It could just chop around sideways, maybe trend up slightly. You got that divergence. It could do something like that before the next leg up as the momentum indicator, the RSI, starts to reset. But when you get a divergence like that, you should anticipate at least a slowdown in bullish momentum, sideways price action, or you can start to look for a dump. Okay, so that's a bearish divergence. Now let's see if we can find other divergences on this time frame. We got right here. So this was in the bottom of the bear market, in the bottom of the bear market. You see this one? So what did we get here? This was during like the FTX collapse. So you got lower lows in price. Okay, you see that clear as day. You got lower low in price right here. And then you got a higher low in RSIs right here. Massive bullish divergence. And what did this bullish divergence indicate? This indicated the bottom of the bear market. If you would have just took a bunch of longs when this bullish divergence, when you identified this bullish divergence right here, you could have just longed this whole area when Bitcoin was at $15,000 or $17,000, and you would have been set for this whole bull run, right? That's why these divergences are very, very helpful. Very helpful. And you could do these on smaller time frames as well. Like if you're a scalper and you want to scalp the 1 hour time frame, okay? And you want to scalp the 1 hour time frame, you could start to look for divergences, and you're going to get more frequent divergences here. And sometimes they play out, sometimes they don't. Sometimes they're lackluster depending on what kind of market you are in. Okay? Again, if you are in a downtrend, like this is a downtrend, clear downtrend, right? Massive downtrend on the 1 hour time frame. Let's just examine this real quick. This is just another example for you. So you got a massive downtrend on the 1 hour time frame. However, you got a bullish divergence right here. You got lower lows in price, and then you got higher lows in RSI right here. You see that? Massive bullish divergence. What did this do? You got a bounce. You got a very, very nice bounce. This gave you, a 5% move, So you got a 5% move on that bullish divergence on the 1 hour. But then what happened? You got rejected by the previous support. You got rejected. You came back down. You tried to retest, and then you got another dump, and then you just set another lower low. You see that? Now you can also argue that this is another bullish divergence, like because you had this low here and then a higher low here. You could ignore this one because you're looking at the longer time. So this is another bullish divergence. You see, you low, higher low. So if you missed out on this, let's say you tried to long this and you got stopped out. Let's say you took some profits here, you got stopped out at entry, or you took a small loss. You could look for the next divergence. Like this is still a bullish divergence, and you could have longed this area over here, and then you would be in the money right now. And the RSI still has room to go to the upside before it gets overbought, right? So, I would expect, hey, this move isn't gonna go forever. And the stochastic RSI is already in overbought territory. And, is it starting to cross over? It's not crossing over yet, but it's starting to get overheated. It's starting to get overheated a little bit. So I would start to be cautious. I wouldn't be longing all the way up here on the 1 hour time frame because of this. Now, again, mind you, this is all relative to what time frame you're looking at. So just because this looks like this on the 1 hour doesn't mean it's going to look like this on the daily. It's overheated on the 1 hour, but we're still very oversold. We are oversold on the daily time frame on the RSI. So if you are a long-term like swing trader, or you're looking to hold this long-term, you're buying in oversold territory, and the stochastic is oversold and is starting to curve up with momentum. So, you know, depending on your time preference, this could be a great long opportunity. I don't see any bullish divergences like on the short term on the daily time frame. You know, like we did have this. We could have caught this too. This was another higher high on price, and then lower high on RSI. That's a bearish divergence. That's a bearish divergence on the daily time frame. If you caught that right here, you could have rode that short. You see? So I don't see any bullish divergences yet on the daily time frame. I would, you know, if I wasn't exposed to the market yet, I wouldn't be buying in on this just based on this alone. I would need to be looking for other indicators. Maybe a bounce off of an important trend line. Maybe wait and see what happens with this RSI. Maybe it does something like this. Like maybe price does something like this. Like it came down. Maybe it's going to do something like this. Maybe you form a slight lower low like that, right? Maybe it does something like that, but the RSI does something like this. Like it goes up, comes down, and then it does something like that. That's a possibility. And then you would have your bullish divergence. You would have lower low in price, but higher low in RSI. So maybe you can enter when you get that higher low on the RSI. That could be a good entry. That would be more convincing than simply longing Bitcoin here on the daily time frame just because it's oversold. You have to consider these things, okay? So yeah, that's it for the divergences. That's how I like to use them in my trading. I like to you know, use the divergences, the different types of divergences, class A, class B, class C, and the hidden bullish divergence. Okay, I like to use those too. So that's really it right now. Oh, and look, as I speak, you know, hey, maybe this is potentially, you know, when you zoom out here, again, that's a hidden bullish divergence. Lower lows on stochastics, higher lows on price. That could be a hidden bullish divergence if this holds. We don't want to see price fall below. If price falls below 78K, that would invalidate this. That would invalidate this hidden bullish divergence. So as of right now, this could be potentially a hidden bullish divergence based on this over here. This is lower low, higher low. So something to keep in mind. Definitely something to keep in mind. But yeah, that's how I would use divergences in my own trading. This is one of my stronger indicators that I like to use. I like to use the key horizontal support levels as like one of my first strongest indicators. But if that lines up with the RSIs, then that's like a major compliment. It's like the RSIs is a major compliment for that, more so than other indicators. All right, so yeah, that's all I got. Thanks for joining in. I hope you understand. If you have any questions, hit me up in the chat and let's ace it.